Truth is, I thought it mattered. I thought that
money
mattered. But does it bollocks? Not compared to how people matter.
Welcome, Mention and other fine folks to the Someday Dispatch of the Black Letter, where we contemplate thoughts worth thinking. A bunch of thoughts on the agenda today. Primarily going to be looking at precious metals, beyond the headline numbers and headlines of what the economy, what they want you to think the economy is doing, to what the economy is actually doing. And then we're going to take a look at the magic 8 ball, see what it can foretell about the future, just for fun. The 7 important gold signals to watch now. Is it too good to be true for gold, or is this it? We will see here. This talks the preamble about a whole bunch of different things in the world that are going on. Kim Jong-un's sister in North Korea apparently just blew up a South Korea liaison office. Growing tension between India and China, which we spoke about earlier. Another increase in coronavirus cases. Civil unrest at all-time highs practically. And then the upcoming election. But the stock market does not seem to care. Recap where we're at. Unlimited stimulus by governments and central banks. Deteriorating government relationships between superpowers. Pandemic that has killed over, almost 500,000 people with over 8 million cases. It goes on to argue here that the Federal Reserve has fueled the fastest and most significant rally seen after any major economic correction. And you can see that here. The yellow is 1929 and the blue is where we are currently. And you can see they kind of moving similarly, except over here from about 20 trading days on, we seem to go a bit sideways. They go down before it goes back up. And we're back up almost at just a little over the highs of what the economic correction did in 1929. I find that interesting because as you know, I think this is going to become known as the Greatest Depression, unless of course they get things handled. And I'm not sure how best they're going to do that, but they're going to have to diminish inequality for one thing, and perhaps the most important thing to do. It talks about an election year for the ages. There's going to be heavy reliance on mail-in ballots, court challenges, so he thinks. I'm not so sure about that. Depends on how well the person who wins does. If they have a substantial lead, it's going to be hard to argue for recounts. So how does gold perform in election years? The usual answer is not very good, except for 2008, which was the last time there was chaos. You can see here that gold has historically underperformed. Yeah, pretty much underperformed every single election cycle, except for when the first time Barack Obama came in. And who knows why that was. But however, gold continues to outperform in 2020, as it says here. On a year-to-date basis, gold is leading the pack across major asset classes, except for Bitcoin, of course. And he is aware Bitcoin is up approximately 30%. And I'm not sure when this was written, because that is not the case. There's no date on this article that I can see. Yeah, there's no date. So this is probably, I would say, maybe a few weeks old at least, because Bitcoin is certainly not up 30%. I just checked. Yeah, we'll have a look and see. I think that's about right. We'll call it there. It's about, 29%, so perhaps it's fairly accurate. Bitcoin is up about 30% this year, which is not bad at all. And gold is up, what is this, about 14% or so. Nasdaq's been doing well. US dollar is strong as well. S&P 500, emerging market. I mean, S&P 500 might potentially test the recent highs before the next downward trend, in my opinion, but who knows. While physical gold and gold stocks have exploded higher, gold-focused producers are still cheap. You can see here, compared to forward cash flows per share, the mid-tier North American gold producers, the junior producers, and the senior producers are all below the price to forward cash flow valuations compared to the Russell, the S&P 500, North American gold royalty and streaming companies. So those are a little overvalued, arguably. He talks about gold price technical analysis. If you're interested, he sees some of these different short-term resistance, support, etc., long-term support trend line. Some folks are thinking that gold could have another leg down before it starts to take off again. But as I said, I think silver is probably a better value, bang for your buck at this stage. It's also cheaper to buy for some of us po folks. The average return for gold in June, July, and August, you can see, is fairly low. These are the sort of the lowest months here for gold. This is 1970 to 2019. You can see that June usually along with March, is a good time to buy. It doesn't go up much, allegedly. Also in October as well. But who knows, it could be different this time because of the coronavirus and Donald Trump. Gold holdings and ETFs are at record highs. You can see that here. Gold price has gone up, along with the total ounces in millions in the ETFs. So far in this run, gold is up 20% and ETF holdings are up over 40%. And then year-to-date returns, the different portfolios here. Anyway, it's an interesting article. I don't really see it as being 7 important gold signals to watch now. I don't know what they're trying to suggest, other than I think perhaps gold has an opportunity to have a slight leg down before it improves. This is a great little blog here, Real Investment Advice. The macro view, retail sales bounce, but consumers are tapped out. It's very interesting to spend some time with this. There was a good bit of excitement on Tuesday with the release of the retail sales report, which came in stronger than expectations. However, the bounce will be difficult to maintain as tapped-out consumers face high unemployment and a slow recovery. Consumers are trained to shop till they drop, but you'll see there's a problem with that. As long as individuals have a paycheck, they will spend it. Give them a tax refund, they will spend it. Issue them a credit card, they will max it out. Give them government stimulus check, they will spend it as well. Don't believe me? Then why is consumer debt at record levels? And you can see it is. This is from quarter 1 of 2020. This is probably going to go up towards the end of the year as well, as people probably have to live on more and more credit as all the stimulus and that starts to end. Can you see what they mean? They're trained to shop to your drop, which means all they see us are as products, right? We're just products to be sold to and to spend our money for the big corporations, our big capitalist corporate captains of industry and titans, right? That's all they care about, that we bleed our money for them. Consumers spending themselves further into debt is what keeps stock markets going higher and the economy going. Note that I said going and not growing. Here's the different, the S&P 500 versus inflation, wages, savings, and interest rates. This is the personal savings rate, which is the big dotted green line here. You can see it's started to trend up, but historically it's been going down. Then consumption and debt. See household debt here, and the PCE is a percent of GDP. And I'm not sure what PCE is, but regardless, the household debt is increasing, and it's probably going to increase more, perhaps before it levels off. Or maybe this was the last great recession we had here, so maybe that'll happen again. We will see this have a little bit of a dip as folks try to pay down debt rather than consume. Since 2000, consumption as a percent of the economy has risen by just 3% over the last 20 years. To support that increase in consumption, it required an increase in personal debt of more than $11 trillion. It has required twice as much debt to increase consumption by 3% of the economy since 2000 than it did to increase it by 4% from 1980 to 2000. There is not much capability to increase consumption that would replicate the economic growth rates of the past. And it talks about the mirage of wealth. Wealth is not borrowed but saved, such as a lesson too few individuals have learned, and that's very true. We're living paycheck to paycheck, most of us. Beginning in 1990, incomes alone were no longer able to meet the standard of living, so consumers turned to debt to fill the gap. However, following the financial crisis, even the combined levels of income and debt no longer fill the gap. Currently, consumers cannot fill the record $2,654 annual deficit to maintain their lifestyle without more debt. Anyway, you can see the gap here. And this gap between the standard of living and incomes is another reflection of the wealth inequality, which is pervasive in the economy. Total sales for the March 2020 through May 2020 period are down minus 10.5% from the same period a year ago. He's talking about the retail headlines in the retail sales, right? It is also likely unsustainable. Stimulus checks are gone and more checks may be problematic to get through a deeply divided Congress. The additional 600 unemployment benefits runs out next month, and there is only talk of a bill to extend them at reduced levels. Unemployment is still a problem. Retail sales make up roughly 40% of personal consumption expenditures, which in turn comprises roughly 70% of GDP. But without a substantial pickup in retail sales, re-employment may be disappointing. It's a chicken and egg. If you can't get re-employed, you don't have income to spend on retail sales. And if you don't have income to spend on retail sales, then retailers cannot hire people, right? The chart below shows retail sales divided by the current 16 and over population. Most people consume, and you can see since the last crisis there's been a gap, and that gap is growing. Projected retail sales per capita assumes a return to full employment next month and progresses on previous growth trends, which is a little bit optimistic here, right? Retail sales per capita were previously on a 5% annualized growth trend beginning in 1992, down here. However, after the financial crisis, which happened here, you can see the dip. The gap is yet to be filled and currently runs at just a 3% growth rate. So it's getting lower, and now it'll probably run at a lower rate too, right? Maybe at a 2.5%. Despite the longest run of employment growth in US history, those who are finding jobs continues to grow at a substantial slower pace than the growth rate of the population. So you can see here, the total increase in population is 25,300, and the total increase in employment is a negative 1,000, which means there's missing millions who can't seem to get a job, or at least there aren't jobs available potentially. What is crucially important to the economy is full-time employment, which creates enough income to expand economic growth. The number of full-time employees of the working age population is at 44.81%, which is not high enough to support economic growth. You can see it's just a waterfall off a cliff. Consumers are all tapped out. The reality is that 80% of Americans continue to live paycheck to paycheck and have little saved in the bank. Consumers using credit to consume. You can see it's just a rocket ship to the moon. The impact on the economy from record levels of unemployment will have a wide range of impacts. The first is a deep suppression of wage growth, which is derived from both recessionary drags and job losses. Exactly. So the more people looking for work, it's a supply and demand thing. So you have a greater supply of people looking for a lower number of jobs, and those jobs can pay less and still attract high quality candidates, right? You can see the compensation, wage, and salary disbursements is generally on a downtrend. With reduced incomes, it is harder to make ends meet, harder to obtain additional credit, given consumers are dependent upon credit to fill the gap, and with banks tightening lending standards, access to credit will become more difficult. You can see here the lending standards are increasing, becoming more difficult. Both of these factors will likely ensure the expected V-shaped recovery in the economy is overly optimistic. The current detachment of the stock market from the economy is likely an illusion that will not last long. Businesses will not immediately return to full-time operational activity until consumption returns to normalized levels, and that's under the best instances, right? It's hard for consumers to remain confident and continue spending when they have lost their source of income. You can see here the real GDP fallen off the cliff since COVID-19. The real corporate profits are also taking a dive here, as you can see. From the financial bubble, it's even worse, arguably potentially going to get worse than this even. So there are some real problems in the market currently. We are just entering into what will likely be a more protracted, deeper, and more damaging recession than what we saw in 2008. Defaults and bankruptcies are only in the very early stages. Liquidity from the Fed has repaired credit spreads for the time being. Still, the longer this recession drags on, the higher the risk is the Fed only delayed the inevitable. So here we are, folks. We're getting some of the real issues, understanding really what's going on behind the curtain, right? Behind the fog and mirrors. We are the land of the worried. 83% of Americans very stressed over the nation's future. New survey shows 7 in 10 Americans agree 2020 is the lowest point in the country's history that they've witnessed. 2/3 say that the government's response to the coronavirus is a source of daily stress for them. Staggering 83% say they are worrying about the future of the United States is a big source of personal stress. Also, 72% believe this is the lowest point in the country's history that they've ever been alive to see. And arguably, I agree with that. Further, 6 in 10 respondents agree that the thought of the U.S. economy reopening gives them significant stress. And then there's some good, some positive spins on this. But what you're seeing, folks, is that people, man on the street, woman on the street, Jane Doe, John Doe, are just really struggling. They're stressed. People who are stressed are not likely to spend frivolously, at least most likely, right? So we're in for a protracted downturn, that's for sure. Continuing unemployment claims tell a bleak story. So here's the continued unemployment claims in 2020. It's sort of flattening out, which is, arguably not a good sign for a V-shaped recovery. For 7 consecutive weeks, continued employment claims have topped the 20 million mark. There you go. Currently at this is 20.544 million. And we're at just about 25 million. But I think it's come down just a hair, right? And that's why it's talking about 20.544 million, which is where we are here, right? Currently, the latest number. Continuing claims only topped the 5 million mark in the depths of the Great Recession. As you can see that here, right? They have now topped the 5 million mark for 11 consecutive weeks and the 20 million mark for 7 consecutive weeks. As the continuing initial claims start to are obviously coming down, which is good news, but it's kind of flattening too. So will we have another month of continuing claims or initial claims, of over 1 million? It's hard to tell. It says initial claims are normally considered a leading indicator. In this case, they certainly aren't. The huge surge in initial unemployment claims is the past. Continuing claims tell the present. Any notion that 20 million people will soon return to work at the same number of hours as before is nonsense. Then he also talks about the retail sales. Retail sales surged to greater than expected 17.7% in May, but the numbers are still well below the pre-pandemic levels. Despite the surge, sales numbers are back to levels seen in late 2015 and early 2016. So this is almost 5 years ago, right? People got money and spent it, but they also skipped mortgage payments and credit card payments. What happens when the checks run out? Fed's industrial production and capacity utilization puts a big negative spotlight on the emerging V-shaped recovery thesis. So you can see here we bottomed out at almost 20. And we bounced back apparently to, we'll call that maybe 45, which we haven't seen since the recession of the early 90s, right? And even here, the industrial production, just general manufacturing, is as low as it's been since before 2000, right? And they only dipped to that level at the end of the last Great Recession. So things are not looking good. Housing starts are near 6-year lows and less than January 1959 levels. Just think about that for a minute. That's over 50 years ago. So retail sales present one picture, but manufacturing, industrial production, housing starts, and continuing claims over 20 million tell another. And that's the picture I'm looking at, not this hopium picture that they want to feed us, right? La la land. The stock market is insanely disconnected and due for a reckoning, Warren Buff warns. So a bit of a misleading headline. If you read that, you think, oh, Warren Buffett is suggesting we're in for a reckoning, but it's not actually. It's a guy who believes in Warren Buffett. Those betting against this absurdly overvalued stock market are about to get paid if Kevin Smith, Crescat Capital's chief investment officer, has it right in his gloomy assessment. Speculation is rampant and being championed by a bold new breed of millennial day traders. He said the mania is based on a widespread hope in Fed money printing. The catalysts for reckoning are numerous, as a major cyclical economic downturn has only just begun. Smith said that shorting stocks is worthy of a significant allocation today. He's used this chart of plunging S&P 500 profit margins to show how insanely disconnected equity prices are from their underlying fundamentals. He warned that buy the dip investors are not paying attention and have simply been too eager to call a bottom. So while this is going up, the stock market here, the S&P 500 index, the profit margin estimate of the SPY is dropping like a stone. You can see what happened. The tech bust, it followed, right? So it went down here and it continued to go up a little bit, but then the S&P index had to follow the profits, right? Eventually, and the same in the global financial crisis. Although here, as the profit margin estimate came down, it seems that in the last global financial crisis, the index came down as well. And we see that here, and now it's fallen off a cliff and this has gone up. So arguably, this has to come back down at least to about here. I would say at least we've got to hit at least the tops of the last couple of bumps here, the double heads, right? In which case that's at about 1500, let's say. So we arguably are in for another 50% haircut from here if there is justice and if history repeats or even rhymes. Smith reiterated his macro trade of the century call that there's never been a better setup for rotating out of overvalued stocks and into undervalued precious metals. So again, somebody else talking about precious metals. Markets driven by euphoria never end well, he explained in a note to clients this week. So there you go. There's some more information to think about. And now the gold and silver ratio. So the gold and silver ratio, as you know, is the current price of an ounce of gold divided by the current price of an ounce of silver. It's a simple numerical calculation that shows how many multiples gold is trading relative to the price of silver, a common indicator used by precious metals investors worldwide. Now this only goes back to about 2000, but you can see that it's an all-time high in the last 20 years, right? And arguably, very few times has it been above 80, as you can see here. The ratio is most useful at its extremes. When the ratio is topped 80, it has signaled a time when silver was relatively inexpensive relative to gold. And we're currently at 98 or so, right? Likewise, the 3 times that gold and silver ratio has fallen below 20 in the past, it has marked a period when gold was relatively inexpensive compared to silver. So I'll just show you that because people are talking about precious metals and arguably gold will do well too. But the gold and silver ratio, currently at 99 actually, suggests that silver has the greater potential upside if, according to the silver ratio, and if this ratio reverts to the mean, which will probably be perhaps, could be 30 to 40, I think would be arguably the mean. All right, onto the magic 8 ball. Will Bitcoin continue to be the best performing asset of 2020? Let's see. Signs point to yes. Well, there you go, folks. You heard it here first from the Magic 8 Ball. At least according to that theorist, our analyst, the Bitcoin is going to perform the best this year. Now, it's been trading sideways for probably weeks, maybe some months. I'm hoping for another dip, honestly, before the end of the year so I can top up my Bitcoin. My goal at some point, if I could ever get to that place, would be to get 1 Bitcoin under my belt. That would be a coup, I would consider it. But who knows, if the price starts getting away from me, I might never be able to reach that point. But nevertheless, put a little bit of money in Bitcoin each month if I can. And I think that's, along with silver, I think those are probably the 2 best places for me to put money currently. I hope you enjoyed this. Look forward to the discussion below. Thanks so much for listening. Appreciate you. Stay healthy, stay well, stay kind. And remember, dum spiro, spero.